2026, where you can buy a $9 iced coffee in 4 easy installments. Yeah, 4 payments for a coffee that's already gone. Somewhere between swipe your card and financial literacy, an entire generation decided the smartest way to buy sneakers, plane tickets, and, I promise I'm not making this up, funeral expenses was to split it into 4 tiny payments and call it not really debt. It's called Buy Now, Pay Later. You've seen the little orange, pink, or blue buttons at checkout. Klarna, Afterpay, Affirm, PayPal Pay in 4, they feel harmless, almost cute, like a coupon with extra steps. But underneath that cute little checkout button is one of the fastest growing, least regulated, least tracked pools of consumer debt in modern history. And nobody, not the credit bureaus, not the banks, not even the companies issuing the loans, actually knows how big it's gotten. Today, I want to show you why Buy Now, Pay Later isn't a payment method. It's a subprime lending machine wearing a hoodie instead of a suit. And I've broken this down into 3 parts: how it got this big, why it's invisible, and who's actually left holding the bag when it breaks. Let's rewind. BNPL isn't new. Installment buying has existed since Sears sold you a refrigerator on a payment plan in the 1920s. What's new is the frictionless part. Afterpay launched in Australia in 2014. Klarna, a Swedish fintech, had been quietly issuing installment loans across Europe since 2005 before exploding into the US market. Affirm came out of Max Levchin's post-PayPal era, pitching itself as the honest alternative to credit cards. No compounding interest, no hidden fees, just 4 clean payments. And it worked, because here's the pitch that makes it genius. There's no hard credit check, no 30-minute application, no staring at an APR that makes you feel bad about yourself. You click a button, answer maybe 2 questions, and you're walking out with a new pair of shoes you've technically only paid a quarter for. By the mid-2020s, BNPL usage in the US had exploded past the 100 million user mark, with providers processing hundreds of billions of dollars in transaction volume every year, a number that's roughly doubled since 2021. Retailers love it because BNPL checkouts convert better and cart sizes get bigger. Consumers love it because $50 now feels smaller than $200 later. Everybody wins. Except math doesn't pair about vibes. $200 is still $200. You just agreed to pay it in a way that doesn't feel like debt, which is exactly the point. Here's where it gets interesting. If you take out a credit card, a car loan, a mortgage, that debt gets reported. It shows up on your credit report. Lenders can see it. They can calculate your total debt load and decide if you're a good risk. BNPL loans, for most of their existence, reported to basically nobody, which means you could open a Klarna loan, an Affirm loan, an Afterpay loan, and a PayPal Pay in 4 loan all in the same week, and not one of those companies would know the others existed. Each one only sees its own tiny sliver of your finances. None of them see the full picture. There's a term for this: loan stocking, and it's exactly what it sounds like. Quietly piling up 4, 5, 6 overlapping tiny debts that individually look totally manageable, but together look a lot like a person who can't actually afford their life. Consumer research has repeatedly found that a meaningful share of BNPL users are juggling multiple simultaneous loans, and a rising share are missing payments, sometimes on essentials, not sneakers, groceries, utility bills, gas. When people start financing their gas station run in 4 installments, that's not a spending habit, that's a liquidity problem wearing a fintech costume. And the credit bureaus finally noticed. Around 2024 and 2025, Experian, Equifax, and TransUnion all started building frameworks to fold BNPL activity into credit files. And FICO began testing new scoring models that account for it. Translation: the invisible debt is about to become very visible, all at once, to every lender in America, right as delinquencies are climbing. That's not a coincidence. That's the fog lifting right before the crash. Now, I know what you're thinking. Casual, it's a $100 hoodie split 4 ways, not a mortgage. This isn't 2008. You're right, it's not a mortgage, but the mechanics should sound uncomfortably familiar. In the mid-2000s, the subprime mortgage crisis wasn't caused by one bad loan. It was caused by an entire ecosystem built around minimal underwriting, lenders barely checking whether borrowers could actually pay, combined with securitization, where those risky loans got bundled up, sliced into tranches, and sold off to investors who had no idea what was actually inside the package. BNPL checks almost none of your ability to repay beyond a soft look at your bank account. And, this is the part people miss, BNPL debt is already being bundled and sold. Affirm has been packaging its loans into asset-backed securities and selling them to institutional investors for years. Klarna has done the same in Europe. Wall Street has quietly built an entire market for buy now, pay later debt, just like the mortgage-backed securities of 2007. The loans are smaller, the stakes individually are lower, but the structure, hide the risk, spread the risk, sell the risk, is the same playbook, just running on a checkout button instead of a 30-year mortgage. So who's exposed if this unwinds? First, the BNPL companies themselves. Affirm went public in 2021 and has swung between profitability and losses depending on the quarter, largely tied to how much it has to set aside for loans that go bad. Klarna finally IPO'd in 2025 after years of will they won't they, betting its valuation on the idea that BNPL keeps growing forever and defaults stay low. Neither company has been tested by a real, sustained consumer credit crunch because BNPL, as a mainstream product, has never lived through one. Second, the banks and asset managers who bought those bundled BNPL securities, the same way pension funds and mutual funds bought mortgage-backed securities in 2007 because the yield looked good and the label said low risk. If delinquencies spike the way early warning data suggest they're already trending, those securities get repriced fast, and whoever's holding them at the top eats the loss. Third, and this is the part that should actually worry you, the borrowers. Because unlike a mortgage default, which takes months in a foreclosure process, a BNPL default just quietly wrecks a credit file that's about to start counting BNPL activity for the first time. An entire generation that thought they were being financially smart by avoiding real debt is about to find out the hard way that 4 payments of $37.50 add up to the same $150, plus a credit score hit they didn't see coming. Here's the part that makes this genuinely absurd. Buy Now Pay Later exists specifically because credit cards felt too risky and too expensive. It was marketed and still is marketed as the responsible alternative. But a system with no unified reporting, minimal underwriting, and Wall Street quietly securitizing the debt behind the scenes isn't the responsible alternative to subprime lending. It is subprime lending. It just figured out how to make you feel good about it. So the next time that little checkout button offers you 4 interest-free payments, remember, the loan isn't free, it's just invisible. And invisible debt have a funny habit of becoming very, very visible all at once, right when nobody's ready for it. This is the subprime bubble nobody's pricing in.